Understanding the weighted cost of capital. The weighted average cost of capital, WACC, is a calculation of a firm's cost of capital in which each category of capital is proportionately weighted. The sources of capital, for a company, include 1. Common stock, 2. Preferred stock, 3. Bonds, and any other long-term debt. WACC is calculated by multiplying the cost of each capital source, debt and equity, by its relevant weight by market value, and then adding the products together to determine the total weighted average cost of capital, WACC. Companies often run their business using the capital they raise through various sources. They include raising money through listing their shares on the stock exchange, equity, or by issuing interest-paying bonds or taking commercial loans, debt. All such capital comes at a cost, and the cost associated with each type varies for each source. WACC is the average after-tax cost of a company's various capital sources, including common stock, preferred stock, bonds, and any other long-term debt. In other words, WACC is the average rate a company expects to pay to finance its assets. Since a company's financing is largely classified into two types, debt and equity, WACC is the average cost of raising that money, which is calculated in proportion to each of the sources. Cost of equity according to the CAPM. RE equals RF plus B, RF, 1. Get the risk-free rate, RF, from the financial press. Many use the one-year Treasury bill rate, say 6%. 2. Get estimates of the market risk premium and security beta. A. Historical risk premium, RF equals 9.4%. B. Value line. 2. Estimate from historical data. 3. Suppose the beta is 1.40, then, using the approach RE equals RF plus B, RF equals 6% plus 1.409.4%, E equals 19.16%. Cost of debt. 1. The cost of debt, ROD, is the interest rate on new borrowing. 2. The cost of debt is observable. A. Yield on currently outstanding debt. B. The historic debt cost is irrelevant. Why? Example. We sold a 20-year, 12% bond 10 years ago at par. It is currently priced at 86. What is our cost of debt? The yield to maturity is 14.8%, so this is what we use as the cost of debt, not 12%. Cost of preferred. 1. Preferred stock is a perpetuity, so the cost is RP equals D, P02. Notice that cost is simply the dividend yield. Example. We sold an $8 preferred issue 10 years ago. It sells for $120 per share today. The dividend yield today is $8 per 120 equals 6.67%, so this is what we use as the cost of preferred capital structure weights. 1. Let E equals the market value of the equity. D equals the market value of the debt. Then, V equals E plus D, so E, V plus D, V equals 100% 2. So the firm's capital structure weights are E, V and D, V. 3. Interest payments on debt are tax deductible, so the after-tax cost of debt is the pre-tax cost multiplied by 1 corporate tax rate. After-tax cost of debt equals ROD, 1 TC, 4. Thus the weighted average cost of capital is WACC equals EV, RE plus D, V, ROD, 1 TC. This concludes a quick overview of determining a company's weighted average cost of capital.